Let's talk some companies, though, that aren't joining in on the fun. Trade Desk and Plug Power. Jenny Horne, host of Next Gen, with a couple big downside movers this morning. Trade Desk first, Jenny, got hit real hard last night. Like as soon as the number came out, extreme conviction that this wasn't a good report.
Yeah, Oliver, I'm beginning to sense a little bit of a theme where this feels like off the open. We're discussing these names in reaction to earnings that are getting just like killed off the open. I mean, this name is down as much as 30% pre-market. Now we're seeing net selling pick up as we opened here. So this has been pretty much weak since we got these numbers, which to me signifies then the strength of how bad this really was. It wasn't necessarily, but it's just what we've seen as far as price activity goes. We are down about 17.5% here, but we did see the company issue fourth quarter revenue guidance that fell well short of expectations. However, their third quarter did top estimates. Earnings per share came in around 33 cents versus the 29-cent share expected. Revenue was around 493 million versus 487 million expected. They now are projecting revenue going forward for their December quarter to be around 580 million, trailing the 610 million that had been expected by analysts. A spokesperson for the company did say that with coming in slightly below consensus, this was because of transitory cautiousness from advertisers in certain verticals like U.S. auto and media companies as a result of some of these strikes. So that was really interesting to me, an unsuspecting company that's getting the collateral damage of the ongoing strikes. They have also seen the fact that, these strikes have resumed. That's, I guess, a good thing, but they do continue to see these brand spend in certain verticals dwindle, which is impacting a name like the Trade Desk. We previewed this name, though, yesterday, and we're talking about the way it's been so resilient this year in its respective space. So I also think to consider this name had been up 70% on the year into its third quarter print. Just the bar had been set so high. Not diminishing an 18% move to the downside, but had been in a position different than any of its peers, really.
Okay. Lower low, lower high. Suddenly this pullback from the 52-week high seems like it's got momentum behind it. I don't think there's any tolerance for misses, to your point on the guidance here, especially in a market that's had some questions about how big the remaining pie is with advertising. At least a little bit of some dip buying. We'll see if it turns in anything. I mean, we're $12 up from where we were at the worst of it last night. So some degree of progress there, if marginal. Let's flip over to Plug Power. There's nothing marginal about this. This is like adios type of action. Holy cow.
Yeah, this is brutal. And this name, actually, the selling has only picked up now as we've opened here. We're down 37%. I initially saw shares down 20%, so this is like the opposite case of what we just saw with the Trade Desk. But Plug Power is seeing underperforming third quarter earnings as well as disappointing guidance. I think the narrative makes sense, not saying it's justifying a 37-38% move to the downside, but this report was objectively worse than what we saw out of the Trade Desk. We did see this company, which has been focusing more and more of its funds on these green hydrogen supply chain and manufacturing fuel cells, not being able to see then consistent profitability as a result of its business model. They did report a third quarter loss of 47 cents per share on revenue that was around 199 million. Analysts had been expecting a loss that was better than that at 30 cents on sales of 199 million. So their top line wasn't a huge miss, but the company did say in its earnings release that the overall financial performance has been negatively impacted by unprecedented supply challenges in the hydrogen network in North America. They warned that given their current position in the operating environment, they will need to pursue or access additional capital in the market to fund their activities, saying they were pursuing a number of debt capital and project financing solutions. They did see cash flow decline by 411 million in the third quarter, now having around 567 million in unrestricted cash and cash available for their current balance sheet. That is a huge problem. If you're saying you need to raise capital to just continue on as a company, I mean, that would make you say, then where are your business, like where are your growth prospects? Where are growth? Like, where is your sense of stability here now going forward?
Ish. It's already been a bad year for everything connected to the EV market, so this just makes it a lot worse. Step on its head when it's already drowning.
Solar, it's been a brutal year for solar exposed stocks.
Yeah, totally. It's just like rough. Yeah. All right. So the green energy trade is not really turning out the way folks had hoped. And I guess for the EVs, the car makers are doing much better than some of the kind of infrastructure connections to it. All right, yikes. Maybe hydrogen is not the way to go. Maybe solar is not the way to go. Maybe it's just dirty old fossil fuels.
You know, I think you might be right now. I hate to say it, but the crude oil looks a whole lot better.
All right, thanks, Jenny. Appreciate it. Supply challenges, unprecedented. Big sell-off.